Good morning, Richard Calhoun, Creekside Realty. We're here today to discuss week 37 in the real estate market in Silicon Valley. If there's any issues where you can't hear me or can't see my slides, please speak up. Here's the URLs. This is how you get to the meetings. The green is my root URL. You add 2022 Saturday mornings at 9 o'clock to get to the live presentation. Normally you add in the letter H for handout 2022-09-17 to get today's handout. They're not posted. I had problems. I will try to correct the problems and post it later. We're going to start off talking about the 4 Bay Area counties, which are San Mateo County, Santa Clara County, Alameda County, Contra Costa, single-family homes. I'm using reference year of 2014 through 2021. Here's the first data slide. This is really key. It's got, to me, really the heart of everything on here. It's showing DUI, which is the blue line. DUI is days of unsold inventory. It's the supply-demand balance, and that's right here. It's hard to see on this scale because we're going all the way back to 2014. Basically, the lower DUI is, the faster the marketplace. Typically, I say anything below 40 days is a red hot seller's marketplace. So right now you can see we're well below 40 days, believe it or not. Yes, everybody knows the slowdown, but we went from basically somewhere around 16, 17 days of unsold inventory. We went shooting all the way up to 54 days of unsold inventory. And then basically in the month of July, we started to improve, and then we're now down around 36 days of unsold inventory. There's no way to predict where it's going to go in the future. To get a better scale, I now have the same data, but only going back to 2019. So you can see that it's come down and it's plateaued. So the blue line, again, is days of unsold inventory. The orange line is the next most important indicator, because I firmly believe that even though supply is equally important theoretically in economics as demand, in real estate, the supply is typically fairly constant. But what's happening with demand is more important than what's happening with supply. Now, obviously, if your supply got cut in half for some reason, it just doesn't happen. But if it did, that would have the same impact as doubling of your sales. When you look at the practicality of it, inventory is typically fairly narrow band. Demand is what varies much more, which is why that's the orange color. You can see it slowed way down. We had very little offers except at the beginning of the year, which is very common, and that's because of the holidays. Real estate's an optional event, so it's negatively impacted by anything that takes people away from having spare time. You can see we got all the way up here right around the beginning of April to a peak of about 1,750 units selling. Then we cooled way down here at a time when the market normally is fairly consistent, down to
I can't hear you.
I hear you fine, Richard.
not inventory. Offers went down and they've turned around. They have not appeared to level off, but it's hard to see where the data point is. It could have come down and be overridden by the gray point. The gray point is the number of available inventory. And you can see inventory was really low at the beginning of the part of the year, which it typically is. Then it climbed like it normally does. Then it climbed rapidly. But then basically starting at the beginning of July, inventory available for people to purchase actually declined. And what I believe happened was the market changed. I think that's very apparent to everybody. And I would actually say earlier than April, probably somewhere about the time Ukraine was invaded by Russia, but somewhere in March. And the reason I'm saying that is the best sale price to list price ratio, the highest, the most aggressive, was at the end of March 26. And that was the 5 weeks before that. So that means basically the 5 weeks before March 26 is, I think, when the market sort of peaked. Everybody moved forward, continued to move forward as if nothing had happened, because we were basically going from a dozen offers on a house down to 3 offers on a house. And if you still get 3 offers on a house, you still sell the house. And then we got to the point where, boom, the demand wasn't as great as the supply, but a lot of agents and a lot of sellers planned their moves a month or 2 or 3 ahead of time. And so they were already committed to move forward, and they continued to move forward, which is why the inventory went up. Then all of a sudden, sellers started to realize, hey, the market's not what it used to be. Sellers started to change their plans, and they came down. Now we're going to jump. And the reason we're going to jump is I had a problem with my data and was not able to get the macro data. Oh, This is actually the slide I thought I was talking about. This is a hand done. So this is updating from last week to this week. So you can see DUI came down and now it's turned around and gone back up. The graph we just looked at ended here. I did this graph manually to get this week's data point, and so we're now up here, which is why it's not labeled, but it's the same as the previous chart. Your inventory here came down and now it's turned around and started to go back up a little bit. Now, 1 week doesn't make a trend. One of the reasons I do data every week is it takes 3 data points to see a trend change. And then this is your demand, and your demand peaked and came back down. Clearly the market's has shifted and it's continuing to find the equilibrium. So you shot up, you improved. Now we appear to be worsening for last week a little bit, this week a little bit more. Whether we go up higher than this, whether we go down and snake out and end up here somewhere, there's no way to know that. Right now, the market's better than it was in June, but it's not great. Where DUI is now slightly above 40. Here's your 40 line. So you're somewhere, and here's 50 up here, and the lines don't line up this quick, the same, which I normally do if I had time. So you're probably somewhere around 48 days of unsold inventory, 46 days of unsold inventory. And again, this is for the Bay counties. So here's where we're going to jump, and I apologize for not having the graphs. And just for people to know, my plan, unless I get negative feedback, is to use the 4 Bay Area counties of San Mateo, Santa Clara, Alameda, and Contra Costa to indicate what's happening in the marketplace. And then someone needs a particular county, we could try to dive into that towards the end of the meeting. So here what you have is single family homes on the left, condos and townhouses on the right. You have the 4 different counties: Santa Clara County, which is sort of the biggest and leading, then Alameda County, Contra Costa County, because they're roughly the same size, and you're going up around the East Bay. And then we jump over to the West Bay and hit up San Mateo County because it's the smallest county as far as volume of sales. And you can see that number of new listings: Santa Clara basically at 200, Alameda at 235, Contra Costa at 220, San Mateo County about 125. So you can see the number of new listings this week is down from last week, which is not a shock. Last week is higher than you would expect because the week before that was Labor Day. The sellers tend to delay going on Labor Day weekend. They come on the weekend after. So the fact that you're going down a little bit 2 weeks after the holiday is basically normal. Total inventory is down here. You can see inventory is basically flat. You're up quite a bit in San Mateo County at 6%. You're down 3.4% in Santa Clara. You can see overall that you've only changed 0.5%. Offers accepted up quite a bit. This is eating up the inventory from the surplus listings that came on the market after Labor Day. So you can see up 23% overall. The real up is Santa Clara County up 40%. The lowest one is San Mateo County up only at 10%. And that's for 1 week. 5 weeks data, which is why I use it, is way more stable. Just look at the magnitude. You know, the highest one down here is 2%. Overall, you went up basically 1% versus 24%. And then down here is sold prices and information based on the 5-week data. So you can see what's happening in individual counties. You can see what's happening in the Bay Area overall. Overall, the appreciation is now 20.5%, and that's from the entire calendar year of 2020. Basically, you're looking at a 2-year appreciation of 10%, and that's fantastic until we get into some of the details later on, where you can see that number was up in the 40s and 50 percentile. So that means anybody that purchased right around March, April of this year is technically at this point upside down, unless they got one heck of a deal when they purchased, which would have been unlikely with the aggressive market we were in. Now what we're looking at is offers accepted, since that's the second biggest thing from DUI, and we're looking at 5 weeks, the 4 counties, and we're comparing it to the 10-year median, and it's not quite a 10-year median. It's again 14 through 21, which I think works out to be an 8-year median, and that's because data before March of 2013 got way unreliable. So I just started off on January 1st of 14 for my base, and I will update the slide. Basically, you can see that here we were selling at the beginning part of this year 500 more units, 100 units more a week than you typically do. And then you can see the change happened right around the beginning of April, came down fairly rapidly. Then in May, there was a bigger decrease. And then basically starting here around July 1st, we've been improving. And even now, it's not getting worse. So the demand side has returned, but you still have a deficit, and you have a bigger deficit. You know, your deficit is probably somewhere around 850 units, that's a bigger deficit than your surplus. Your surplus was only 500 units. So your deficit is close to double what your surplus was, which is why we're sensing the change. And the biggest reason we're sensing the change is we've gone from the 500 surplus to an 800 shortage. That's a drop of 1,300 units in 5 weeks. That's almost 300 units a week. Here's actually the numbers. We're now selling only 650 units. You can see raw count going back. I'm comparing it for 10 years. It's the worst out of the last 10 years. And you can see how dramatic the change was. Earlier this year, we were basically second only to 2021 because of COVID surplus. And by April 8, we were actually the highest. But then we basically went from the second best year here early in the year up through March to rapidly the worst. Now, yeah, you had some sevens and some fives and some nines, but that's rapidly moving towards the 10th place. That's how dramatically the market shifted. Now we're going back to my old data, especially because I didn't have the Bay Area data. I'm now calling this blended data versus macro data. So blended data is San Mateo County, Santa Clara County, single family homes, condos, and townhouses. The reference is 15 through 19, so it's only 5 years. Here's your overbid. You can see the burnt orange line through here was last week. So there was quite a deterioration from last week to this week, which caught me a little bit by surprise. But when you look at it globally, you basically reached a plateau where you're bouncing around here. All the solid lines, which are 8 weeks, are fairly closely together. You can see the dashed lines are fairly spread out. That was while we were transitioning from the hot market to the slow market. And the dotted lines are the beginning of the transition up here, and the red bold dotted is our best week ever. So you can see there was, basically somewhere around 20 weeks ago, we were close to the best marketplace we've ever had. And then starting in week 19, which I think is this blue line, to 18 to 17, you basically came down, which is a decreasing marketplace. But I would absolutely say we've plateaued now. The gray line back here was about 3 weeks ago now, September 3rd. Here's 4 weeks ago, 3 weeks ago, last week, and then this week. It's bouncing around, and anytime the data starts bouncing is an indication you're not shifting one way or the other. Same data set here. It's just only the last 12 weeks. So the dotted lines are all in the transition. The dashed lines are starting to be the beginning of the plateau. So again, the plateau has been about 8 weeks. You could probably even throw in these first 2 dotted lines. So we've had about a 10-week plateau, probably because there's a pretty big gap through here. So probably a 9-week plateau, which if you whip out the calendar and go back, that's probably all the month of August and probably a couple weeks in July. Again, every indication is shortly after July 4th holiday, the market came back and stabilized a little bit. Clearly slower than it had been, but still not a bad marketplace. This is looking at 1-week data using the blended data. You're looking at the available inventory in blue. We have less available inventory than normal. If you had normal inventory, you'd be on the yellow line. So this is an indication that sellers now realize the market isn't strong, and those sellers that don't have to sell are holding off, keeping the inventory down. Number of new offers is below the yellow line. What I think would catch a lot of people by surprise is this improvement here, where basically week 33, 34, 35, we're basically all at or above normal level of offers accepted. The demand came back, and that would have been basically towards the end of August, the last 3 weeks of August, the demand came back. Then you can see again, as we hit Labor Day, it dropped. Now, initially I was blaming that on the timing of the holidays, and that's true. But now the fact that it stayed down, it's more than the timing of the holidays. So you're basically not as bad as we were earlier this year, but also you don't have as many demands as you'd expect. And with the Fed's raising interest rates, trying to cool down the marketplace, they're being successful to some degree because we're only selling, what is that, about 84% of the normal number of offers we accept. Number of new listings coming on the market. You can see the huge gyration caused by the holiday, but again, you only have 80% of the listings coming on the marketplace as you'd expect. And we'll get to a slide later on, but I'll do a spoiler alert. Santa Clara County actually has a shortage now of inventory. I think the number is going to be 77% of the inventory you'd expect in just Santa Clara County single family homes. Because remember, this is blended data. And I'll come back and try to get consistent and replace macro with blended. But these slides were supposed to be out of here, so I didn't bother doing that. So here you're looking at a balanced marketplace in the white. You're at the very bottom end of a balanced marketplace. You're right on the cusp of going into a seller's marketplace, which is why you can't see the line. It's being covered up by the red line. So you're right there on the border. And these thresholds of going from a balanced marketplace to a seller's marketplace, they're not black and white like the lines in the graphs are. Those are just arbitrary points. It's a blended thing. So clearly the market was slower here. And the only reason I believe that people reacted the way they did was because we were in such a hot marketplace. This was actually a fairly reasonable market. Now we're back to a fairly hot marketplace, and people think it's still pretty much a buyer's marketplace. It's just what we get used to. The human body gets used to what it's been experiencing for about the last 2 years. Here's looking at the two counties, both types of properties, so blended data. This is looking at the new inventory coming on the marketplace, so you can see it came down, and the number of new offers. So you can see the offers came down, turned around and improved, and then they've dipped down just a little bit the last 2 weeks. Here's your DUI. That's the ratio between the two. So you can see you came down, you got into the seller's marketplace territory, then you turned around and you came up. And here you're showing this number looks a little bit closer to like 42 days of unsold inventory. So again, a strong marketplace, not what we've been used to recently, but something that we shouldn't really be complaining about. Days on market. I think this is a pretty pointless slide, but a lot of media covers it. So your median days on market is 18, very respectable number. Average days on market is somewhere around 27. The reason I don't really like this number is it lags behind and really doesn't show the detail. See how smooth this is compared to my DUI graphs? The DUI graphs show that the market really did slow down and then improve. Here's your sold price, which obviously people are always concerned about. You can see the peak pricing. Basically, I think now we're basically back to pricing that we were in about April of 2021. So most of 21 was flat. So really the only people that are upside down significantly are the people that bought right at the end of 2021, which is when the appreciation from 2022 was getting pulled forward, those that purchased in 2022. So now you can purchase and you do your CMAs back here from almost 18 months ago, which is very unconventional, but I think gives more accurate answer, especially with it going. I'll pause and see if anyone's got any question, and then we'll continue with a little bit more detail. Not hearing anybody, and at this point, feel free to interrupt as we go along. Now we're just looking at macro data, blended data, Santa Clara County, San Mateo counties, condos and townhouses, and single family. The yellow line is the 5-year median in raw count. So for those that don't like percentages, where you'd expect the new inventory to be is up here somewhere around 575, or down here somewhere around 440. Less inventory is coming on the marketplace. That's because sellers have now adjusted to the new marketplace and they're delaying their activity. Total inventory. Here, this is the blended data is below where you'd expect it to be. Blended data for the 5-year period of time, 15 through 19, which was 5 good years, was 2250 up to 2450. We're down here at 2100. Clearly a little bit of shortage of inventory, and it's a little oxymoron. There's a shortage of inventory, which makes it hard for buyers to find houses, but sellers are having a hard time selling the homes that are on the marketplace. Here's the number of offers accepted. Again, slightly below raw count. You're somewhere around 425 normally, and here you're probably somewhere around 360. Again, a deficit. The buyers aren't buying. With interest rates and with the lack of inventory, they have reason potentially not to purchase. Here's your DUI. This, I think, would shock a lot of people. Remember, red is a red hot seller's marketplace. You can see these numbers in a good part of Silicon Valley, or at least Santa Clara County, are getting to be fairly red numbers, 25, 30, 27. And then you go up into San Mateo County, more balanced, 39, 40, 37, and you can see there's a slight shade of pink. The only area that is blue, which is a slower marketplace, is the very expensive areas in San Mateo County, and they tend to be slower along with the Saratoga Las Gatos marketplace, along with South County, and also the San Mateo County coast. Those 4 areas are sort of outlying for one reason or another, and they tend to be less active. But basically, the heart of Santa Clara County is pretty aggressive. And here's going back over over time. And then this is showing DUI only. It's in the week. So you can look up here. This is the week ending May the 7th, the week ending September the 16th. I report on the 17th, and I know I should get a little bit more consistent. A lot of times I use the reporting data. Sometimes I use the date that the data ends. So in this case, I'm using the date the data ends on. But look how much redder the column is here than it was, say, back here in July and August. So again, the red is the sellers favoring the sellers. You started off very red, you started going very pale, and now you're coming back and you're going red. And more areas are showing red and deeper red. Now, yeah, you could argue that San Mateo County up here slowed down a little bit. That's fine. I would absolutely agree with that. And this breaks out the single family homes on the top and the condos and townhouses at the bottom. And I skipped last week, so I'll go back and see if I can't bring that in so we have it going forward. Here's your DUI. This is where I was talking. The blue line, the thin blue line here is 5 weeks, 5 days of gain in DUI a week. And that's about where I call the threshold. And I was, concerned about this rise because it was very close to 5, but it was also at a time when DUI is normally rising. So I said, the market's shifting, but it's not the dramatic change that we see when we go racing into a buyer's marketplace. And sure enough, we did an abrupt face. We improved dramatically. And then you can see and this is daily data here, even though we only meet weekly. You can see the last several data points on the daily data has indicated the DUI is going up. One of the advantages of having daily data, I start feeling comfortable once you start having 3, 4, 5 data points, especially when they're this consistent, that again, the market is now slowing down a little bit, at least as measured by days on unsold inventory, which I believe is the best indicator. Now you're looking at DUI based on, I believe, 5 weeks up here. No, 1 week, and it's combined data, but you're comparing it to the 5-year median. So basically, you're right where you'd expect it to be. You can see you were much slower during the peak of the summer. You were much slower in the blue line than the yellow line. Now the yellow and the blue line are mirroring each other. So basically, you're having a very typical year of 15 through 19, which again, nobody really complained about those years. We complained about 18 and 19 a little bit because we went through 17, but if you compare them to 15 and 16 or a normal year, they weren't bad years. Here's the magnitude of overbidding. Now, the key here is we're again 5 weeks, but there's also a 5-week delay. I'm talking about the market improving in the last couple of weeks. That's not going to show up in the overbidding yet because these overbids were negotiated for the most part 5, 6, 7 weeks ago, call it 4 to 7 weeks ago, depending on the length of escrow. So the overbidding is determined by the conditions the buyer and the seller are sensing when they accept the offer, not when they close. It does not surprise me that there's essentially no color. And the reason there's no color for most of these is anything between 99 and 101.5 is no color. And if you look real carefully, you can see a little tiny pink coming up here at the 102.2, and I can see a little tiny shade of blue here for Saratoga Los Gatos at 99. But when you go and put that shade on the map with all the discolorations of the map, you can't see the shading until the shading gets more severe. But basically, that's your magnitude of overbidding. Here's the magnitude of overbidding graphically over time. I mean, this is dramatic. Santa Clara County single-family homes in the red went from somewhere around 118% of the seller getting 118% of their asking price to very rapidly coming down and getting only their asking price. And if you look at this, you could almost argue, at least in Santa Clara County single-family homes, has this plateaued or is it actually turned around? I would still call that a plateau. Your condos are still coming down. Your San Mateo County are still coming down. Santa Clara County has done a bottom. Will this level off and go back up? I expect it will go up a little bit based on the recent improvement, but now the fact that the market's already turning down, I think this is going to be a fairly aborted improvement. Here is magnitude of overbidding again, and this is over time. This, I think, is 1 week data, so you can see there's some bounce in 1 week data. And again, that's why I tend to favor 5 week data. Gets rid of some of the stabilization, because when you see an increase like this for last week, you go, wow, is the market improving? And now you see the market dip like this, and you're going, is the market deteriorating? And it's noise. And you can see how jagged this line is. Here's the frequency of overbidding. This is how common in the overbidding is. And you can see in some of these areas, it's getting into the blue territory. And that's where less than 1/3 of the sellers are getting more than their asking price. This is the frequency of overbidding over time. You're up here from 90% of the sellers were getting more than their asking price to now somewhere right around 40, 50%, 40 to 45% of the sellers are getting more than their asking price. Here's the frequency of overbidding for 1 week. And again, you can see the bounces return. And the purple line designates 2022 on the left and 2021 on the right. So you can see the dramatic difference in the data from last year. Last year at this time, somewhere around 75% of the sellers were getting more than their asking price. This year it's at 40%. So that's a pretty dramatic drop. Here's the sold price distribution. The color is assigned by the median number, which is in the middle. The number to the left is the cheapest 10 percentile. The number to the right is the highest 10 percentile. So between the outer two numbers, you know that 80% of the homes sell at between that price range in that area. Here's the price breakdown over time. And again, you can take each one of your components and take the data of now and draw a horizontal line back. And you can come back here and you can go, yeah, somewhere around April, July, most of 2021 is the price point where we're at again. And then you go up to San Mateo County and it's the same thing. San Mateo County bounces a little bit more. And you could actually argue you can go all the way back to maybe like March of 2021 in San Mateo County. And condos are more stable. You can see they did a dip here, which I never understood why they did this dip. It's very unusual. You can see how consistent they are. And then it came up and improved. And now it came back down and gradually, more gradual. Condos and townhouses tend to lag behind single family homes and tend to be more stable. Here is the appreciation chart, which I find just to be fascinating. These high numbers here, for the most part, were reached in the month of May because it was closings. We don't have them for the individual months, but basically you were in the 40s and 50s. You actually even have a 64% here. And now you come over here and you're basically in the teens. And yeah, there's a lot of variation. South County, for example, went from 50%, 51% to 36%. Santa Clara County, the entire county went from 44% down to 17%. But some of these areas are huge. East San Jose, South San Jose, Central San Jose, 46% down to 12%. 12% appreciation for 2 years, because I'm comparing this over the entire calendar year 2020, is good. It becomes only bad when you compare it to where we were just a few months ago, and you're losing 25% of your price. And unless you purchased then, it was a paper gain or loss. But losing 25% of the value of a home since May is, I believe, one of the most rapid price declines that I've ever experienced. We've seen bigger declines, but over longer periods of time. Here is the breakdown of the different micro market areas. So you can see the condition in each one of the areas. You have the DUI, again, redder, the hotter the marketplace, the magnitude and the frequency of overbidding. Magnitude comes next because it's the most sensitive, and then frequency, and then finally price. So you can look at where it is. And this is the condo data. There was absolutely no color in any of these areas. And so you have solid white. Every one of them is between whatever I said it was, 99 and 101.5 in here, and then here between 33 and 50%. So there's no color. So it's not the data's missing. Here is the spoiler. Okay, we only have 71%, 72% of the inventory you'd expect to have. Your DUI in Santa Clara County single family homes is 36. That's a seller's marketplace. It's the strongest marketplace out of the four. San Mateo County is at 46. Santa Clara County condos is at 38. Redwood City, Bay Cities is at 82. Clearly, this is the slowest area up there. And we've talked many times about how they've rapidly built up there and on the low end, higher density, lower priced homes, magnitude of overbidding, frequency of overbidding. And then here is your peak appreciation for the county, 44% down to 17, 37.7% down to 7%, 34% down to 15, 17% down to 7. And that's a -7. This is blue even regardless of how you went, because you've lost 7% over 2 years. But, normally these would all be, well, this one here would normally be black, but they're all blue, which is a cool marketplace because of how high they were just earlier this year and how high they were at the peak of 2021. Now we're shifting gears to Santa Clara County single family homes only. This is showing the improvement in DUI over 5 weeks, and you can see it came down, turned around and worsened a little bit. Now it's plateaued. And, I wouldn't make hay or either way on this, because you can see this is daily data, so it fluctuates more. It came down and improved, and it's plateaued right now is the way I would read that data point. The thinner lines, this is your median for the 5 years. This is the highest number for the 5 years. This is the hottest, the fastest marketplace. This was the coldest marketplace. You can see earlier this year, we were the slower market than we've experienced from 15 through 19, which is why everybody was going, wow, what's going on? But now we're actually better than we were over the 5-year median. And I don't think most people realize that. This is looking at the difference between DUI and the median. So you can see DUI was above the 5-year median, because here's where it's right at the median. And now you can see it at the bottom. And what's really interesting is even though DUI looked flat, which it was, the delta compared to the median is plummeting, because DUI is normally increasing at this time of the year, which is why I do the delta. Here's the 7-day average, and you can basically see here the market's continuing to improve. And that's why I like looking at data differently, because if you look at the DUI, it looks like the market's stabilizing. But if the market's normally going up at this time and now it's stabilizing, that's a market that's still improving compared to where you'd expect the market to be. So the 7-year delta is improving. And here's for people that like to look a little bit in the future. I'm basically looking at September data, which we can't have until October the 6th. This is only September the 16th. Today's the 17th. This is through midnight the 16th. But it allows you to come up here and look at things like DUI. We're at 36, clearly slower than the last 2 years, but faster than the 2 years before that. And, if you go back and look at it historically, we're basically better than a lot of years since 2012. We're way better than a lot of the years in early 20s, 2025, 2020. 2006, 2007, these numbers were really high, and now we're sitting here at 36. Sales are definitely low. It's basically the lowest number on there, 942. You can go back and look at all those numbers are all above 1,000, except for 2019, where it was 2025. It's hard to say what number we're going to be on October 6th, but you're the same order of magnitude. Coming down to overbidding, 100%, one of the lowest numbers since the market started its rapid recovery after the mortgage meltdown. So from 2012 on, this is one of the lowest numbers that we have. But if you go back to 2011 through 2003, the data, the 20 years data, it's basically one of the better years. So you have to keep things in somewhat perspective. Here's your median price. We're the same as where we were a year ago on median. And I think with that, this is the same slide, but going back for August for the people that want to compare August apples and apples. I don't like doing this one because it's in the rear view mirror. And with that, this is the slide you see at the beginning. And here's my URL. So I'm open for questions. Not hearing any. Again, go ahead.
Hi there. Hi there. I was just wondering, you said you might do some of the micro markets at the end. Are you still going to do that?
I could go back. I don't. Go ahead.
I'm just looking at San Mateo County because it looked like on one of your screens it was hot. On the one that was the comparison with the color comparison.
Yeah, I went back to the color
purple, but it looked, this one over here, the 2 million to 9 million. It looks pretty red.
Why
for expenses in Mateo County.
Okay.
Up here.
Okay.
Yeah, there.
Okay. You got to remember that on pricing, red has nothing to do with the heat of the market